mistakes business owners make is hearing a tax strategy on TikTok, YouTube, Facebook, or from, hey, my buddy next door, the one I go to networking with. And they immediately ask, can I do this? My answer is always the same. It's maybe. But first, we need to take a look under the hood, see what all's going on. A tax strategy is not like walking into a coffee shop. What might be good for you isn't going to be good for the guy ordering behind you, the guy or the girl ordering behind you. I'm Michelle Masacchio with Fit Money CPA, where Vet Med meets smart business. So today what I want to do is kind of pull back the curtain. We're going to pretend we're in the Wizard of Oz and show you exactly what we look for before giving tax advice to a client. So every week I hear something along the lines of, should I be an S Corp? Can I write off my vehicle? Should I buy a building? Can I hire my kids? I heard about a captive insurance company. Can I do that? Someone said I needed a trust. The reality is, a tax strategy without context is just entertainment. It's just something to think about. Before we recommend, again, we evaluate the entire financial picture. And the first thing we start with is income. The logical thing, and you might ask why, it's because many tax strategies only make sense if you're in a certain income threshold. For example, an S Corp may save thousands of dollars for one business owner, but absolutely nothing for another business owner, and could possibly even cost them more due to compliance issues. A cost segregation might be fantastic for one business owner, and again, it may not work for another. So the first question is, how much are you making right now? And how much do we expect to make in the future? So the second factor we look at is your entity structure. And I'm going to ask you, are you sole prop? An LLC, which an LLC can be a sole prop because remember, an LLC is a legal entity. Are you a partnership? Are you an S Corp? Are you a C Corp? So different structures can bring about different opportunities. And I often see people implementing strategies that they've heard about online. We already talked about that, but it doesn't make sense for your entity type. And it would like taking tires and putting them on a motorcycle. So again, before we recommend anything, we're looking at your income and we were asking your entity type structure. Third factor is cash flow. I know, surprise. But a strategy might be able to save you taxes, but if it's ruining your cash flow, that's not going to help you any at all. So let's suppose you want to purchase a piece of equipment that's going to generate a huge tax deduction. And, I'm going to say great, but what's your cash flow look like? Do you have enough cash on hand? Do you have enough projected cash coming in so that we can still pay our monthly bills and that it's not going to cause us any harm? Remember, we want that run rate to be about 3.5 months. So again, we want to make sure that we have enough cash flow to cover that. So the fourth factor is business goals. What do you want to do? What do you want to get out of your business? When do you want to leave? All of those types of things we have to understand before we can make that recommendation. If you're planning on getting out of Dodge next year, it's probably not going to make sense to buy a piece of equipment right now. So the fifth thing we look at is risk tolerance. So I know you're familiar with this when you're talking to your investment advisor and they're asking, how much risk do you want to take? It's how much are you willing to, for lack of a better reference, lose? You might be purchasing a piece of equipment that it may be used and you don't know what the maintenance has been on it. So you're taking a higher risk that it might not work for very long. Number 6, state tax impact. Everybody's always thinking about federal taxes, but state taxes do not always follow federal rules. So we want to make sure that if you are in a state that does not follow the feds, that we are looking at the state level as well. And timing. Timing's everything when we're planning. I want to know, is it going to be this year? It's a good strategy for this year, next year. Is income going to increase? Are we decreasing? And is this a major purchase? Or is there another one coming down the road? So the 8th factor is documentation requirements. IRS, they don't care about a lot of stuff, but what they do care about is that you can document what you're doing and that it falls within the IRS code. So we want to make sure when we're talking tax strategies, everything we're doing, we can document. Because if anybody were to come knocking, we can just hand it to them and say, here's why we did it. Here's where the code section is. Here's the case law that supports it. We're all solid. So, again, what we want to do is look at cash flow, look at profitability, growth. We look at the whole picture before we suggest a strategy. So it's the tax tail does not always wag the dog. Again, sometimes we need to do something for other than tax reasons. We look at what makes sense to you right now. And yes, we always want to pay as little in tax as possible. But again, sometimes that tail might take us in the wrong direction. So we just want to be sure. So let me ask you this question. What's the most interesting tax strategy you've heard about? Go ahead and drop comments at it and see where you guys are coming from, what you're seeing out there. So, Michelle Masacchio, Fit Money CPA, and we will touch base later.